What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this week's episode is Jeff Currie. Jeff is global head of Commodities Research at Goldman Sachs and one of the absolute best people to speak to about the commodities industry, commodity markets, the dynamics at play in the context of corporate risk management and geopolitics, and how to invest strategically and gain exposure to what may be the biggest commodity supercycle in at least 40 years. This was by far the most informative conversation I've ever had about commodity markets and the physical economy. Jeff is a fountain of knowledge and uniquely good at breaking down the market dynamics and material importance of an industry that pulls in every single aspect of the global economy, from capital markets to supply chains to international politics. My objective in bringing you this conversation is twofold. Number one, I fully agree with Jeff's overall thesis that we are in a commodity supercycle and that this is going to have massive implications for governments and economies all over the world. Understanding these dynamics is crucial for businesses and governments who need to navigate and plan for a future that is going to look radically different from anything that we have seen in a very long time. Number two, anyone managing money, whether it's their own money or a client's money, needs to understand what is happening in the real economy today and how multiple cycles of underinvestment, rising costs of capital, deglobalization, and wealth inequality, just to name a few, are converging to create the greatest period of financial, economic, and political change in 100 years. Fortunes will be made, and many more will be lost during this period. And today's conversation with Jeff is yet another important piece to understanding this very big puzzle that we have been putting together on this podcast for years. As most of you already know, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. So the second hour of today's episode with Jeff is available exclusively to premium subscribers only. You can access that part of the conversation as well as the transcripts and intelligence reports to each episode by visiting our website at hiddenforces.io, selecting the episode that you're interested in, and clicking on the premium extras where you can then sign up to one of our premium content tiers. Since some of this episode deals with investing, it should be absolutely clear that nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guest are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this highly informative and timely conversation with my guest, Jeff Currie. Jeff Currie, welcome to Hidden Forces.
Great. Well, thank you. It's a pleasure to be here.
It's my pleasure having you on, Jeff. I told you right before we started how much I've been looking forward to this conversation. We've done a series of episodes where we talk about the commodities markets. They're relevant in so many ways, but we've never dedicated an entire episode to it. And you are one of the best, if not the best people that I've followed on the subject. And obviously, having you on it also gives me the opportunity to read a lot of your work, which is normally not available to me. So that's also been really wonderful. Before we get into the subject of this conversation, give me a quick and brief sense of who you are and how you got into this business.
Actually, how I got into the business, it was right in the middle of Gulf War I in 1990. Oil prices were at $40 a barrel. The global economy was in a recession, and the only thing hiring were oil companies. Ended up doing price fixing cases, and I just finished my master's at the University of Chicago, and it realized that there was no future in doing this without finishing the PhD. So I went back, finished the PhD with all this oil data, and wrote a dissertation with the oil market being in the center. The title of it was The Geographic Extent of the Market. And I went out on the market, only person doing commodities and oil at the time, and Goldman was building up its J-Air and commodity trading business. And it was my first job, and I've been there ever since. And that was 1995.
So actually, one of the questions I wanted to ask you was what kind of knowledge base or experience set does someone need to have in order to be successful in this space? Because obviously, it's not just about the specifics of any particular company. Right there in what you said is geopolitics. That's a huge part of what informs the space. So I'm just curious, how does it compare to other parts of the business? And what do you need to know to be really good in forecasting this space?
When I was working on my PhD, my focus was in price theory. And the one thing about commodities, it's all about supply and demand and the laws of economics and how prices are developed. You can think about it this way. Commodities are about the now. There's spot prices that have to clear today's supply and demand markets, while financial markets are about the future. They're all about expectations. I like to point out financial markets like equities, really difficult to model because it's all expectations. But it's much easier to forecast because all you're forecasting is what people think. In contrast, commodities, very easy to model, but really difficult to forecast because it's things like the weather. And by the way, one point though, is you start thinking about longer term as you go out and, 2-3 years out, that noise of weather disappears and it becomes these big fundamental drivers of supply and demand, which are forecastable. Now you think about an equity, if it's all driven by expectations, you can get a handle around them over 6 to 12 months. But where are expectations going to be 2-3 years down the road? It becomes much more difficult to forecast. So I like to point out longer term, commodities are forecastable. Near term, pretty difficult.
Fascinating. That's also very, very interesting. So I do want to get into the structural drivers. Before we do, because I've thought about this quite a bit, just given the sort of breadth and depth of this conversation, of the subject matter, maybe the best way is to start very high level and for you to give me your thesis on the big picture in commodities. In other words, what the story is as it pertains to the supply-demand dynamics in the commodities market, because just calling it commodities or your view on commodities doesn't really capture everything that it involves. So where do you feel like we are today? What is the grander thesis? You talked about it in terms of the commodity supercycle. How would you describe it?
It's part of a much bigger cycle here in the sense that, we went through a period, from 1980 to 2020, really being characterized by globalization, efficiencies, deregulation, and it was a period of deflationary pressures. But one of the costs of that 40-year run was substantial income and wealth inequality. And when we think about what the core drivers of commodities and other real assets, it's the lower income disadvantaged groups. Because think about this with corn. Does a high income guy consume that much more corn than a low income guy? No, they all consume about the same. And when we think about, does the high income guy adjust his corn consumption across the business cycle? The answer is no. Only the low income guy does. And so when we think about this environment in which you had a drag on low income activity over that 40-year period, you saw a significant drag on the demand for all of these real assets that reinforce that deflationary backdrop. And so as we go into this new cycle where we're going to have to fix issues like income inequality, we're going to see substantial increases in the demand for real goods. In fact, I like to point this out, and there's no exception to this. All commodity big bull markets and periods of inflation were all driven by lower income groups. You cannot find an exception to that, which tells you if we're making an argument that, income inequality is something that needs to be addressed globally, and you look at China with its common prosperity initiatives of, U.S. as well as European governments, they're all moving that direction, which will ultimately reinforce this longer term commodity demand.
Yeah, that reminds me of a quote from Adam Smith that I read years ago about how a man can only wear so many coats, that, like you said, with the inflation that we've seen over the last several decades, has gone primarily into financial assets. And it's interesting thinking about the demand dynamics driving inflation in this context. So one of the structural drivers, of course, being redistributive policies. You actually have this acronym, I think you call it RED, redistributive policies, energy transition, and deglobalization. Walk me through those three structural drivers and how are they essential in this concept of a commodity supercycle?
Okay. When we think about going back to this point, the lower income groups drive the demand for food, fuel, and capital goods. So the question is, how do these policies in this shift towards macro policy focused on social need impact the demand? And there's three avenues, and it's your point that, the redlining, redistributional policies, we call it environmental or energy transition policies, and then deglobalization policies. Starting with the redistributional policies, that's things like, the furlough program here in the UK, or you have the American Recovery Act in the US. All of those coming out of the pandemic were focused on the lower income groups. By the way, the catalyst for all of this really was COVID. COVID was a crisis of inequalities that exposed them in a very raw form everywhere in the world, that then forced these governments to simultaneously, on a global basis, focus on these disadvantaged groups. And that's all these programs I was just listing off currently, but they're not ending with the pandemic. Once you start these programs, it's far more difficult to go backwards. And you look at, whether people talk about the U.S. with fiscal policy coming to an end, running a red-hot economy that's overheating, creating inflation, employs everyone. It's another way of creating jobs and employment for these disadvantaged groups. So there is a benefit. Obviously, that's the inflation employment trade-off of above capacity economy, because, ultimately everybody's getting employed. In fact, you look at the evidence of an overheating economy, it closes the gap between, rich, poor, race differentials, gender differentials, you name the differentials, they get closed in an overheating economy. So this is not just about fiscal policy, because people look at me and when I say this, the redistributional policies, they go, well, the BBB failed, it's behind us. No, there's a lot of other strings that can be pulled. And also, it's a global story. It's not just about the U.S. U.S. is only 25% of this story. The 25% becomes its share of global GDP. And again, China has its common prosperity. So that's the redistributional policies. Let's talk about the E, the energy transition. This is the war on climate change. And by the way, it's very much, you can think about the redistributional policies being the war on income inequality, the energy policies being the war on climate change. The two are very much tied. And when you think about conservationist policies, things like, EVs, where you're basically reducing your consumption of fossil fuels, these are regressive taxes. They don't really hurt the high income guy, they hurt the low income guy. And in places like India, in other parts, Brazil and so forth, it's very difficult to think how they're going to bear the cost of making this transition. So when you think about that war on income inequality, it's very much tied to this war on climate change. But why is this bullish commodities? We're going to embark on one of the most expensive endeavors, if not the most expensive endeavors human beings have ever attempted. We're talking about replacing the fuels that we use for the way we do manufacturing, the way we create transportation, and the way we heat and cool ourselves for 250 years. Carbon is pervasive. It's in our clothes. It's everywhere. And if we're going to get it all out, it's going to cost an unprecedented amount. And we would argue that the amount of CapEx this decade is roughly about 16 trillion, which is equivalent to what China spent in the 2000s. So it's one China this decade and two Chinas the next decade. That's at a big CapEx cycle. And then let's bring in, the deglobalization. It's kind of, again, call that the war on free trade, deglobalization. And when we think about deglobalization, it's very much tied to the other two. Because why are we deglobalizing? Or it's all about protectionist policies to protect your lower income groups. This really gained traction with Trump in 2018 with the trade war with China. But ultimately, that was basically aimed at protecting the disadvantaged groups that were hurt during the globalization or the rise of China over that time period. And what is decarbonization? Decarbonization is deglobalization. If you aren't using oil a chemical liquid-based fuel that you can move around the world, and you move to electricity, that's a localized market. So by definition, decarbonization is deglobalization. And it is being done in terms of protectionist policies. The last time we saw a period of deglobalization was, following the First World War in 1920. And you look at, the Labor Party in 1923, it looks very similar to the Trump victory in 2016. So these protectionist policies, when you hit these peaks in globalization, and by the way, income inequality in 1920 was as bad as it is today. And you get these political responses. So I like to say globalization, the income inequality is not they're not directly relinked. It's the political response to the income inequality that creates the deglobalization. But how does this create commodity demand? You have to build duplicate manufacturing sectors to protect your own industries. Let's look at Germany. It has a brand new shiny pipeline, Nord Stream 2, and it's talking about building liquefaction plants in U.S., Qatar. All of that costs money. It's capex. It's demand for commodities. So those are the big, and we like to say it's redlining commodity demand. And the catalyst here really was COVID.
So one of the questions that I have coming out of what you said was that figure you cited of $16 trillion to get us from here to where we need to be. What was the comparable investment made in the 1970s to bridge the gap at that time? Obviously, we weren't decarbonizing, but there was new supply that came online in the 1980s as a result of investments made in the 70s. What is the comparison there between the two?
Actually, if you look at the comparison, we weren't decarbonizing, but we were desulfurizing. That was the war on acid rain. And you look at the setup in the 70s, it pretty much identical. You had the redistributional policies was the war on poverty that LBJ did. The environmental policies were the war on acid rain. And by the way, Nixon was the one who signed into law the Clean Air Act Amendment in 1970. By the way, they didn't get to that point until Lake Erie was on fire. So we're going to get to the point where policy starts to get serious about decarbonization, but I think the public needs to see the evidence of it like they saw in the 1970s. And then the third, the deglobalization, you had the Cold War with the Soviets, big military spend. So it was a very similar setup with the same big three drivers that created a huge global capex boom that went in from the 60s and peaked out in the late 1970s, but driven by very, very similar forces. By the way, the 2000s, it was another way to think about the 2000s to keep in this idea of redistribution. Really, what was China? Look at China in 2001. We called it the sleeping giant. Why? Because it had all the ingredients to be an industrial powerhouse. It was disconnected from the rest of the world. The trade towers go down in 2001. George Bush Jr. needs to get a vote in the UN Security Council to use force in the Middle East. He trades a vote in the UN Security Council for admission to the WTO. That's why it happens right there at the end of 2001.
I didn't know that connection. I didn't know that. I've never heard that before.
And, in fact, look at the date when it happened. It was like, the vote for the UN was like September 13 or 14, and the admission to the WTO, when the announcement was like September 17th, it was just boom, boom, boom. But I think the key point there is in December of 2001, you integrated China with the rest of the world. And this unleashed a powerful outsourcing arbitrage. And it was a gigantic redistribution of policies between rich Americans and Europeans and low-income rural Chinese. In fact, 400 million low-income rural Chinese. And when you saw that happen, that created that huge increase in demand that created that commodity supercycle and inflation inside of China. Goes back to my point, they're all the same dynamic at play, and it was no different. So I know I've got beyond your question of the 70s, but the 2000s and 70s have a lot in common, and this is the whole idea of redistributional policies.
No, that was great. Actually, I'm reminded of our lengthy conversation with Michael Pettis, where we examined this dynamic in great detail. For anyone that hasn't heard that, or for anyone who has but wants a refresher, it's very relevant to this conversation. So to that point about demand and the structural forces of demand in the 1970s. First of all, am I correct in thinking about this as the third supercycle, commodity supercycle since the 70s, including the 70s, the early 2000s, and today?
Absolutely. And by the way, here's another big parallel to make because we've been talking about demand. And I know you're going to want to bring supply in, but let's bring supply in right now. Going into these periods, late 60s, early 70s, and in the late 90s and the 2000s, you had the same underinvestment theme. We call it the revenge of the old economy. Just put bluntly, poor returns in the old economy saw capital redirected to the new economy. And by the way, the capital did the right thing. It was chasing the higher returns in the new economy and choking off the capital that would have otherwise been used to grow the supply base in the old economy. So what was it in the 60s? The Nifty 50. Big equity boom that took capital away. What was it in the 1990s? The dot-com boom. And in the 2010s, it was the FANG boom. But they all served the same purpose to take capital away from the old economy. But what makes this one far more binding than what the other two were? You put an ESG overlay on top of it, and I'm beginning to appreciate that the banking regulations, following Basel III, are starting to have a significant impact on supplying capital to the sector. The bottom line is, going back about 15 years ago, the world wrote off capital-heavy investment for dead. We wanted everything capital light. And you can't just completely go on, forever without making investments in capital light. And it's pervasive. I like to point out, even if you wanted to grow oil's shale supply, you're out of sand, you're out of pressure pumping capacity, trucks, and I can keep on going down the list. We have not been investing in it. So going back to the similarities to those other things, they all were preceded by these big new economy equity booms that ultimately took capital away from the old economy.
I love that. So we're going to dig into the supply side story because there's so much there. Just to reemphasize your point, the underinvestment is common to all of the cycles. The bottlenecks to reinvestment are particular to each cycle, and that's what we're going to get into on the supply side because it's fascinating. But just to close out some points on the demand side, I want to understand the distinctions between the 70s, the early 2000s, and today, because it seems to me that the early 2000s stand apart. The forces of deflation and the rise of inequality was still happening. Interest rates declined dramatically between 2001 and 2003. So first of all, am I correct in thinking that the early 2000s really stands apart here from the demand side dynamics? And then are the demand dynamics going to be even stronger this time around than they were in the 70s because of the giant wave of globalization and all the inequality that derived from that, which is a boon to redistributive policies, which are inherently inflationary?
I would argue, and if you just take the trade data and you correct it for oil prices, the current round of globalization didn't start until after Reagan. So the 1970s were the end of the deglobalization period from 1920 to call it 1980 when Reagan came in. Because ultimately what Reagan and Thatcher did is they tore down all the regulatory framework that was put up during that period of 1920 through 1970. You think about, income inequality was at a peak in 1920. What happened between 1920 and 1980? Socialism, communism, trade wars, trade unions, the list goes on. All of these protectionist policies, that were put up, and economic sanctions, oil supply shocks, all of it. And it came into a pitch in the late 60s and the 70s, which reinforced that story. So if, anything what we're talking about today is far more similar to the 70s than it is to the 2000s. But if you just take a step back about what the 2000s, what it kind of was, again, just a big, gigantic redistribution policies, because once the decision was made to admit China to the WTO, you just redistributed from the United States and Europe into lower income rural Chinese, and you had to build cities and everything to accommodate that. So in one sense, it's kind of the same, but I agree with you that you had the deglobalization forces, the deflationary forces that were all in play in 2000s that weren't there in the 1970s. And, obviously in the current environment, everything's reversed hard. That's why this story is far more powerful than the other two.
Great. So let's transition to the reinvestment side of the story. You have a lot of these really great short quips, sayings. And one of them that I really like is that this market is long conviction, but short position, which I think speaks directly to this point about reinvestment. What do you mean by that? And why is that the case? Why are we short position despite being long conviction?
I think there's actual real capacity constraints on the ability to invest in this space. I can go, look at, data that look at different funds. They just don't have any position in energy, basic materials, or anything in the commodity space. They don't even have people there that could do this. So their ability to rotate into old economy is severely constrained by the capacity to do it. And then you have banking regulations like Basel III that are in place that make it really difficult for the banks to be able to provide the funding to this space because all those regulations push everything into capital light. And I think that's what makes this one so much more difficult to solve. I like to point out that when Volcker took interest rates to 20% in 79, you just had 5 to 6 years of massive capex going into commodities and old economy. So at the exact same time, you were debottlenecking the system. Right now, I actually don't know how you're getting the capital into the system right now. And it's like, I don't think that they don't want to do it, but I think that what they're worried about, is that they don't have the capacity to do it, and that it's going to take time to put that in place. But if I went back and I talked to people who are, sitting in the position that make these capital allocation decisions, they tell me there's 3 reasons. Reason number 1, returns in the sector were absolutely abysmal over the last 10 to 15 years, and nothing short than epic losses 2 years ago when oil prices went negative. People want their money back. They don't want to make investments in this space. And all their memory is it's been, absolutely money-losing proposition. So that's point number 1, and I would say it's the highest on the list. Point number 2, the volatility is too high. We've been on this call for 15, 20 minutes. I don't know where oil prices are. They could be up or down $5 right now. We've been experiencing that kind of volatility, and it makes it really hard to invest. And it creates what we call as a volatility trap. The higher the volatility, the lower the incentive to invest, which then reinforces higher volatility, creating a vicious cycle that reinforces the volatility. Where I was testifying in 2003 in Congress on this point was the only way you stop this is government's got to come in and create an environment that makes it conducive for investors to be, feel safe in making these capital investments with that type of volatility. And that's what ultimately had to happen in, markets like U.S. natural gas. And then the third reason they put is actually ESG. I know a lot of the listeners probably think ESG is top of that list, but the bottom line is you can't say everybody's constrained by ESG, but everything in the commodity space is underinvested. So you have to say there's another reason other than ESG why they're not making these investments. And hey, it's just a history of bad returns and lots of volatility.
I definitely want to talk about ESG because even in something that's not related to ESG, which was the self-sanctioning that we saw around Russia, it's fascinating to me to see the extent to which the private sector has taken the initiative to enact what would effectively be policies in a different age driven by the government. And we'll get into that. I'm interested in talking about that. But before we do, you mentioned volatility. You have this other saying, which you call a volatility trap. Explain what that means and why is it that investors, institutions in particular, are caught in what you've described as a volatility trap? And how does this relate to the way in which these institutions manage and look at, identify risk?
I call it a volatility trap because if you have spare capacity in the system, adequate inventories, your volatility remains low and prices remain low. And that was essentially the world we lived in from 1980 until, call it, 2020. And, obviously there was a period in 2000s where eroded a lot of it, but there was a lot of excess capacity built up coming, during the 1980s, coming out of the Cold War, all of that. And at this point now, most of this has all been exhausted. I'm not making light of the war in Ukraine or anything, but there was an article in the FT yesterday morning that Russia can't produce any more guided missiles. It didn't invest in any of the factories or the parts or anything to do this. This is all investment that was a hangover from, they call it the 70s and the 80s. They're out of capacity. And it's not just, Russian guided missiles, it's everything in the global old economy, capital heavy sector. So it's difficult in terms of thinking about if you don't have that capacity, you don't have that spare inventory cushion, the volatility begins to rise. And so, I'd like to point out then that, okay, the volatility gets to a high level, the returns are not sufficient, or at least the investors don't think it's going to be long lasting because of the volatility. they're unwilling to make the investment, which exacerbates the problem and just makes it worse. And we go around and around and around. And here's a saying I like to point out. Spot prices solve surpluses. Long-term contracts solve shortages. Why is that the case? Because if you have that volatility, the only way you take it out is through a long-term contract where you've just locked in the returns, the investor knows what they're going to get, and the capital flows and you get the investment. The spot price is used to clear markets when you have too much of the stuff. I like to point out is that you look at spot markets in most commodity, everybody thinks they've been around forever. No, they all came into being in early 1980s, basically coming out, that period with that big overhang, and they really took a life in the 1990s. And in fact, you look at the commodity businesses, how did they start? The ones that like at Goldman and whether if it was Enron at the time or Morgan Stanley, what they were able to do is get between corporates that had those long-term contracts with a lower cost of capital and create the financialization of those longer-term contracts. Whether it was more spot markets, all these spot markets and everything that we look at that we deal with today were all created in that 1980, 1990 time period, but they were used to solve that surplus. The long-term contracts that were in the 70s were used to solve a shortage. What do we have right now? Shortages. To overcome that volatility, we need these long-term contracts.
So what does that mean for price levels and for prices further out on the futures curve for these various commodities that are experiencing structural shortages?
There's 2 points here. There's one is the price level, which I firmly believe you got a lot of upside price movement in these commodities to be able to get the investment to flow. But there's the other one, taking the volatility out. And there's 2 ways in the 70s they took the volatility out. One was through conglomerates, merging balance sheets to share risk. The other one was through just long-term contracts, but they weren't financialized. What they did was just go agree, let's put a long-term price of X and we both agree to it. We've taken the uncertainty out and the investment flows. Now there's the question is what is the price level to get that investment to flow? So if you take the volatility out is one step. The other step is to get the price that the investment's attracted to. And by the way, the other thing we haven't even talked about yet, because the capital hasn't started to flow, you're already at $108 barrel oil this morning. What is the upside once they start spending? Because once you get that CapEx out there spending, then it creates a whole new round of inflationary pressures. And so then that number is going to go higher and higher and higher, which then that kind of risk also concerns people, which is why it has a history of losing money. In fact, you look at the returns that were generated at $140 oil in 2008. They weren't that great. Why? Because the cost had gone up so much with all of the CapEx spending and the inflationary pressures that creates. So that's a whole nother discussion, but the one we are making right now is about the volatility.
No, walk me through that. That's fascinating. So why does that result in inflationary pressures and what in particular?
Man, let's take shale production in the United States right now. Now, people ask me, why can't they get to the 2018 type of growth rates? They can't because you're out of sand, you're out of pressure pumping capacity, truck drivers, trucks, and so forth down the line. Okay, if you want to, we estimate you can get 1.2 million barrel per day growth, which is far short of the 2 million barrel per day growth that was achieved in 2018. Now, they can try to go after 2 million barrel per day growth, but what would it create? Inflation in oil services, rigs, truck drivers, sand, the things that you're out of. And so, because you can think about this is that because we haven't invested in the space so long, and now we're going to try to invest in it, the people aren't there. They went out and got other jobs, and we didn't invest in things like pressure pumping capacity. The trucking problem in the U.S. is we didn't invest in warehouses, trucking, and all of a sudden you got this boom in demand. You go, where is it? And then once you go out and you try to build all this stuff, because you haven't been doing it for so long, that puts upward pressure on those prices. So you get cost inflation. And we haven't seen a CapEx cycle globally since China in the 2000s, so almost 20 years ago. And we get a big CapEx boom, whether if it's, green CapEx, brown CapEx for, copper and everything that has to go into the green. And then you get a defense boom. You put this all together. That's the kind of CapEx the world hasn't seen in so long. And again, I'm talking about comparable to the 70s. It was defense spending. It was, the green capex to solve remember, it was Superfund sites and things like that in the 70s. And, you put that all together, it starts to create a lot of pressure on the system. So big capex cycles, they create inflation in their own right because you're spending for the first time in a very long time.
Mm-hmm. So I actually have two sets of questions. One is a continuation of this, which is essentially how long does it typically take for investment to enter the space in these types of cycles? And how long does it typically take for valuations of the equities to peak? That's kind of one set of questions. But the other thing I want to close it off, the conversation about volatility, and I didn't have a chance to ask you, which is, how is this reflective of what we've seen in previous cycles? And how did we overcome the volatility issue or this, quote, volatility trap in previous cycles? Or was it not as relevant because bank regulations were different in each one?
It was a different solution. I mean, if you can think about in the 1970s, it was overcome through creating conglomerates. Like you listen to Tesla, he wants to buy nickel companies. That's a conglomerate.
You're offsetting the risk by owning the actual important input that you need for your final product.
By the way, the problem with that is once this problem goes away, you're stuck with the asset. You're better to rent your way or lease your way out of this problem than buy your way out of this problem.
To your point about long-term contracts.
Mm-hmm. And the other way they did it was through, long-term contracts. But, the government stepped in. Like the government has the farm subsidy programs and things like that because ultimately it's a social good to get this investment and the volatility down. But it's been in the 70s, it's a combination of, all three of that, conglomerates, long-term contracts, and then you had the, government, providing subsidies and, whether if it was drilling and gas production and farms and things of that nature. Now, in the 2000s, everything was financialized. Going up into 2008, there was a derivative for everything you could imagine. And so you diversified it. But what we found out, it was, companies like AIG just writing insurance contracts behind it that were not, that the risk wasn't fully diversified to deal with all these different contingencies that started to happen. But that was the way they dealt with it in the 2000s, called a fully financialized response. Now, when we think about, how they're going to deal with it this time around, one, as you point out, the banking regulations are going to make it far more difficult. Because, you have people out there talking about the systemic risk associated with commodity trading companies. This is not systemic risk. This is low risk capital. That's the reason why it left. It's a capital hog, but it doesn't have a lot of building pipelines is not a risky business like it is going into tech. That's why it's low returning, but you got to be in it for a really long cycle. And then you think about with like these, with the trade houses, with these long-term contracts, and they need to have access to more capital, it's because the margin calls are going up for something that they have the offset. It's a hedge that they have the offset to it. Or take commodity trade finance. You got the ship that actually backs the money. The problem is getting money to there requires pushing against leverage ratios. And even they aren't focusing on the fact that, this may be levered up a lot, but it's not as risky as many of the other endeavors in the economy. But it's not high returning, so people really don't want to take away from other parts of their leverage ratios to do it. So I really wonder, the ability, your point is the banking regulations are very different today. The ESG regulations are very different today than what they were before, that actually sourcing that capital for what are relatively low risk endeavors is going to be difficult.
Yeah, I've heard this take as well. I think most notably Zoltan Pozsar from Credit Suisse has, I think, and I don't want to misrepresent his views, I think has made the case that there is the potential for systemic risk. Are you differentiating between liquidity and solvency risk here, to your point about the fact that they have the underlying commodity? It's just a matter of the short-term capital needed to actually complete the deal? And what are people missing in this equation?
That it's backed by the physical. But I mean, the only risk you have here is that the physical disappears. That something happens where they don't have access to it. And then you would have, a huge liability that's not being backed by an income stream. But you're talking about relatively small amounts. You take the whole amount of commodity trade finance, it's something like $2 trillion. You put that in the context of the subprime then that was 15 years ago. Just the subprime itself, I think, was somewhere around 3 trillion. And put that in real terms, it's what, it's twice the size of this. And this is a global in nature. But I think the key point here, there's physical systemic risk, meaning, I can't produce this, which then creates a trigger to produce that and that and that. But that's inflationary because, yes, what we were witnessing earlier, it just drives up the prices of everything, in terms of creating a financial crisis that, I put it at relatively low probability. For one, the space it's too small. There's been no capital going to it. And by the way, the current problems you're seeing are a function of just bumping up against leverage ratios. Because, if there was no leverage ratios, the banks would just extend the credit to it because they also see that it's relatively low risk because it's backed by
the collateral.
By the collateral.
So I want to go back to this long conviction, short position thing. Does that only strengthen the bull case this time around, especially for anyone that feels that they can weather the volatility? And also, is it fair to think about the bull case here, as partly being that investors are getting in ahead of the government, that the government is going to be getting into this space and that you're beating them to it?
The upside potential because of the lack of investment is substantial here. But is it any different than what we've seen in the past so far? No. And I think you asked one question before, which is, what's the timeline on this? You talk to the investors that make these decisions, they want to see a 3-year track record. And then they'll put their money to work, not of the money manager, but of the whole entire sector. This is not a flash in the pan experience and prices are going to go crashing back down and we make capital investments. And so when we think about the 2000s, prices started, exploding in 2002. It was, late 05, 06 that you saw the capital move in about 3 years later. And then once the capital moves in, then you get the inflationary pressures of spending, which is the next leg up. And then once you got all the capital in place, it's about, 3+ years to get all the investments that can produce. Because you look at these super cycles, the one in the 70s started in 68 and ended somewhere around 1980, 12 years. The one in the 2000s started in, call it 02, 03 and ended in 14. So again, and call it 12 years. So is it 3 years to establish a track record, 3 years to, create some inflationary pressures and get the capital in place and, create the conduits to spend it. And then it takes another 4 or so years to actually get the production actually flowing again. And that's why these things are 10-year cycles. I'm hypothesizing here. I don't fully understand why they're 10-year cycles. But this one, actually, I think it's going to be a lot harder, going to your point, whether if it's ESG or due to banking regulation, it's going to be harder to get the capital to flow to the sector. Because remember, this is capital-heavy stuff. And we haven't seen capital-heavy investment for well over a decade now.
So we haven't even gotten to that place of having established the track record yet,
no,
correct?
I'd say we're 18 months into it.
Okay. So you have another saying that I really like and that I think speaks to something that some of the folks mentioned have also brought up. And that is that we have lived through a period of a savings glut, which we sort of talked about earlier with respect to rising inequality and deflationary forces, but that we're going to be living through a period of a spending spree. Can you explain to me what that means and what is the impact of that on the petrodollar system, on the value of the US dollar, and on the value of dollar-denominated assets?
First, let me tell you about a story. I went to go visit SAFE, State Agency Forex in China, and this is around 2005. I went to go pitch them GSCI, take some of that excess savings and put it in the oil market. When I got to their office, they're like, "Get out of my office with your puny little oil market. It serves us no purpose." They were having to spend $100 billion per month, and the market cap of all commodities at the time was $450 billion. It was too small to accommodate the type of spending they needed to do. In fact, you really think about spending $100 billion per month. It's really difficult. In China at the time, remember, China was just coming out of being a rural agrarian society. By the way, 1995, China was a net exporter of all commodities. And in 2005, and now all of a sudden has $100 billion a month, it's got to spend it. It couldn't. The only market that could accommodate the liquidity that they needed was the U.S. Treasury markets that had the scale and the size. And by the way, everybody's talking about the demise of the U.S. dollar. The reality is you need to have a huge, function, liquid bond market to be able to create a reserve currency. There's no other international bond market. By the way, who created that big bond market? It was Reagan. He cut taxes and increased spending and did it through debt. By the way, why was he able to do that? It's because inflation got rid of all the U.S. debt in the 1970s, so he came in with a clean slate. But it was the creation of the FIC market, the fixed income markets, which then allowed for the dominance of the U.S. dollar in that whole period of globalization from, call it 1980 to 2020. So the point being here is they had all this money that they got off of globalization, but they didn't know what to do with it. The only thing large enough to accommodate it was the U.S. Treasury market. Now, let's fast forward to 2022. Can these countries spend that money? Absolutely, yes. They don't need to recycle it back into U.S. Treasuries or anything like that. In fact, what would you do at 8.5% inflation? Spend it. We're talking $11 trillion of excess savings that was built up over the last 20 years. I don't know if you ever looked at a picture of it. It's just a line going straight up. And during that time period, as it went up, it weakened the dollar, obviously, because what was happening is you're printing more and more dollars, outside of the U.S. And this went on until, call it 2018, 2019. And then essentially, with the trade war, it really started to slow down and the development of these reserves essentially stopped. Now with the high commodity prices and the trade coming out of China, they started developing reserves again. But what you see is they're not saving it. They're spending it. You take Saudi Arabia, they have entities, like ADQ in Abu Dhabi. It was built, by the way, I learned a new term of Q, is Qadaba, it means holding company. These things are built to go out and spend this money. They're like development banks. They're going to go out and build infrastructure, power grids. Actually, as one of them was talking to me, as an Iraqi, made this point to me, we don't need to buy cell phones from, other parts of the world. We could build them ourselves. And my question was, why are you doing this now? Why didn't you do this before, is diversify these economies? And I think it was that whole idea of globalization. One, you specialize in what you're really good at. And then two, they didn't have the capacity locally to spend that money. So you plowed it back into the U.S. Treasury markets, lowered it. That period you were pointing out earlier about interest rates dropping from 01 to 03 and all that time period. Why? Bernanke pointed out, he called it the savings glut, is pumping that money back into the U.S. It's petrodollar recycling or whatever you want to call it. It all occurred. And that put the downward pressure on rates and the funding costs. Now, you're Saudi Arabia, you got your NEOM city you're going to go out and build. They're going to diversify. That's that Vision 2030. They're going to diversify that economy. Abu Dhabi's doing the same. Chinese have one belt, one road. They're going to spend. And, a lot of people go, the devaluation of the CNH, it's going to be terrible for commodities. But remember, they've been building, all of these countries, these emerging markets have building up huge reserves of dollars over the last couple of decades. You're saving it for a day like this to go out, build, diversify yourself, buy the stuff you need. And what is that going to do? It's going to put more upward pressure on commodity prices.
Okay, great.
So that's why I call it spending spree.
All right. I want to dig into that further. So what is the reversal of that petrodollar recycling dynamic do and mean for, again, the value of the dollar, separate from the dollar's role as a reserve currency? Actually, address both of those, but address them separately if you can, or delineate them. And what does it mean for the cost of capital for building out additional capacity to service the demand? And how does all of that tie into the case for higher commodity prices?
Okay, well, let's go back to, the lack of excess savings. By the way, the evidence right now is they're spending it. So this is not me hypothesizing about a spending spree. It's being spent. I mean, look at PIF in Saudi Arabia. It was developed precisely to do this. And so what it means is if this money is not going back into U.S. treasuries and U.S. equities and U.S. and European financial markets, the cost of capital's got to go up. There's only one conclusion here. It has to go up. So you're taking away a big source of it. And by the way, the one thing about what created that negative correlation between the dollar and the oil that existed throughout a good portion of the last 30, 40 years. It was the fact that when oil prices went up, and it was a proxy for everything from Barbie dolls and everything, because you look at the price of every exported good in dollars. Everything went up and down with the price of oil. So when the price of oil went up, the amount of dollars that would be accumulated in South Korea for, let's say, exporting Barbie dolls would go up. Same thing in Saudi Arabia, same thing in China. By the way, why is the price of Barbie dolls correlated to the price of oil? Think about this. If you price Barbie dolls in constant, let's say, Korean won, and the dollar is correlated to the oil price, that means the dollar price of constant Korean wons has to look like the oil price. So higher oil prices meant everybody was going to get more dollars. And they get those more dollars because they didn't spend them. They put them into financial markets or banks. You would get dollar creation off of those dollars. And then that would weaken the dollar as the oil price went up. And so if they're not going to put that money into savings that it can create more dollars, and this is what was confusing Bernanke in 2005, that savings glut, through higher oil prices and everything would create those dollars, which would then, new supply of dollars would weigh on the dollar as well as weigh on interest rates in the US. So now, in the current environment, if they quit spending them, the supply of dollars is going to get tighter and tighter. The cost of funding in the developed markets is going to get much higher. So you're going to lose the supply of the dollars. I'm not the FX guy, and I don't want to get into this whole debate. I look at it, I go, what this is telling you, you're going to get more spending for real goods, commodities, and other real assets in local markets, less dollar supply because you're not going to be putting them in financial markets where they can create more dollars. So that's really the conclusion. I'll let you discuss. I don't believe in the demand story is going to disappear for dollars, is because what are you going to replace it with? And by the way, if trade's falling, how many dollars do you really need?
So this is super interesting, and not to stretch your expertise here, but are we talking about a situation in which we would experience a long-term structural reduction in dollar liquidity, which is another way of saying a reversal of the post-Bretton Woods dollar carry trade? And what does that mean for foreign exchange volatility? What does it mean for hot money flows? And also, what does it mean for the short-term value of the dollar if there are fewer dollars being created, but the demand is still there?
Let's make it really simple here. 2005, China, Saudi Arabia, and all the EMs get a windfall of dollars. They can't spend it because they don't have the local capacity to spend it. What do? They buy U.S. treasuries. By moving those dollars into financial markets, they could reproduce. They can be lent out to other players or whatever it might be. It's the multiplier associated with it sitting in banks or in treasuries or whatever it might be. Today, these enormous economies, China's the second largest economy in the world, give them $100 billion a month now, they could spend it like that. Or take Saudi Arabia. If their Vision 2030, they're going to spend it. They're not going to save it. So what that means, and you can think some of these countries like Egypt and other things, and they're going to draw down that excess savings to buy oil, buy food, and other things like that. It means you're going to get more and more of it put back into the real economy as opposed to sitting in the financial markets.
Okay, so I have one more question I want to ask you related to this, and then we'll move it to the second hour on the premium feed, Jeff. And that has to do with the interest rate cycle. So one of the other distinctions between this cycle and the previous one, and even the 1970s, is that we're at the rock bottom of a long period of interest rate decline, 40 years roughly speaking. How does that impact this story if financing, which we just touched on just right in the last answer to your question, right, becomes more expensive and harder to source?
These are all the same story. Take income inequality and turn it upside down. It looks just like that interest rate cycle you were talking about. Where was peak equality in the United States? 1979, right at peak interest rates, peak real commodity prices. They go all hand in hand. And so we're now at an extreme like we were in 1920. We're at max income inequality, extremely low interest rates. Why? Because the wealth, you plowed all the money into financial assets. Because you think about the capital holders in Europe were the huge benefactors of the globalization that essentially ended in the 1910s, so call it 1920. That's why income and wealth inequality, the robber barons in the U.S., all of it were very similar type of dynamic as we were at that point in time. And so in 1979 and 1980, when this current cycle started, where interest rates declined and deflationary pressure started, you were at max equality. You had fixed the problem in 1920 by, call it 1980. But the cost of fixing that problem was barriers to trade and regulation, and the list goes on and on and on. And then the Reagan and the Thatchers came in and tore down all that regulation, and then you got the benefit of it, but the cost of it was income inequality over that time period. Mm-hmm. And we're now at the turning cycle. And you look at that, it's like, hey, all of this is kind of teed up to go one direction. And that the structural forces, for higher commodity prices, is there. Because any way you solve income inequality means it's going to be more demand because you're making them better off. I realized this a year ago. Somebody asked me and go, well, isn't inflation bad for low income groups? No, it's not. It's bad for the higher income groups. In fact, another client pointed this out to me. Never in the history of mankind have we solved income inequality by bringing the low income groups up to the high income groups. We do it the other way. We bring the high income groups down to the low income groups through inflation. Because what is inflation? Monetizing the savings of the high income groups. But I think, the key point there is ultimately the whole idea of inflation is you're giving capital to the lower income groups. They spend it, which then creates the demand for food, fuel, capital goods, and these types of commodities. And so if we're talking about we ran this cycle, deglobalization. By the way, that's why I use these three things, the RED, red lighting demand, to split these three dynamics up. But they're really one and the same. They're all doing the same thing. Because, redistribution of piles, deglobalization, it's all the same, which is going to create that demand. And, it's going to reduce that savings gets spent. And as it gets spent, it creates inflationary pressures. Less savings puts upward pressure on interest rates, commodity prices, and everything else as you go through that cycle. So, whatever you want to name it, it's all pretty much the same thing.
What a fascinatingly complex line of work you're in. I mean, there's like an endless number of things to learn in order to deepen your knowledge. So I said we're going to move it to the second hour, Jeff. I want to give listeners a sense of where I want to take this conversation. I want to discuss the geopolitical dynamics of all of this, specifically as they relate to key commodities, because that's, I think, another thing that's been challenging for folks, myself included, which is what commodities do we need to focus most on? The most obvious story that people can wrap their arms around is energy and food, right? So like they hear that there's a war in Ukraine and they find out that Russia and Ukraine are two of the biggest wheat producers in the world. Okay, well, that means that wheat prices are going to go up. I can understand how that would impact food prices. I can even understand how that might impact political stability in a country like Egypt or some other countries that are closer to the poverty line and where food is a bigger part of the consumable budget. And I can even stretch myself to understand how that might impact migration, which could destabilize Europe and the European Union, et cetera. I think what's even harder for people to wrap their heads around are things like the interplay between natural gas and fertilizer, or steel, neon gas production, and chip manufacturing. So there are so many hidden aspects to this story that I'm only beginning to understand. Those are things I want to talk to you about as well. I want to ask you about natural gas, LNG. Can Germany really run its economy off of liquefied natural gas if they wanted to cut themselves off entirely from Russia? And if they can't, does that mean that they can, or that Europe can eventually source pipe gas from other areas, the Middle East, Eastern Med? Can they do that in time to save their domestic manufacturing industry? I mean, what does this mean for long-term German manufacturing? And of course, I want to ask you about how people can, if this thesis speaks to them, whether it's today, after today's conversation, or they hear today's conversation, they do a bunch of research and they're like, okay, I'm on board with this, or at least I'm on board with it enough that I feel like I need to get more exposure to this trade. How do you actualize that? How do you translate physical profits from the commodity space into a financial trade, financial asset? That's something I definitely want to ask you about. For anyone new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second part of today's conversation with Jeff, as well as the episode transcripts and intelligence reports, head over to hiddenforces.io and check out our episode library, where you can also become a premium subscriber today. Jeff, stick around. We're going to move the second part of our conversation onto the premium feed. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.